Good afternoon, everyone, and welcome to the Federal Reserve Bank of New York's Economic Inequality Forum, the impacts of COVID-19 on communities of color and policy insights for an equitable economic recovery. My name is Marissa Casillas-Barnes, and I'm a member of the Community Development Team here at the New York Fed. I would like to remind everyone that this event is being recorded and is on the record. There will be no question and answer portion. Without further ado, I would like to turn it over to John C. Williams, President and CEO of the Federal Reserve Bank of New York, who will provide an opening statement. Thank you for joining us today, John. The floor is yours.
Thank you. And hello, everyone. And I'd like to add my welcome to the New York Fed's third Economic Inequality Policy Forum as well. It's a pleasure to speak with all of you who are joining us for this conversation. And for me, today's event is about sharing research and hearing your recommendations. So I'm going to keep my opening remarks relatively brief. Now, before I continue, I have to give the standard Fed disclaimer that the views I express are mine alone and do not necessarily reflect those of the Federal Open Market Committee or anyone else in the Federal Reserve System. Since the outbreak of the pandemic, we've seen severe economic pain, unprecedented levels of unemployment, and enormous uncertainty about the future. The health and economic effects of COVID-19 have created tremendous hardship for many Americans across the country, but they've been especially painful for communities of color. We know that people of color, and Black people in particular, have experienced higher rates of illness and death, significant representation in essential services work, and insufficient access to health care are key factors that have contributed to these outcomes. The pandemic's convergence with a moment of reckoning for the United States around racial justice makes conversations on issues like equitable growth even more important and relevant. Now, when I think about equitable growth, I think about an economy where everyone can realize their full economic potential. While today's conversation is about equitable recovery, everyone here is aware that an equitable economy did not exist before the pandemic. And another important dimension of equitable growth is equal access. And the pandemic exposed just how dramatic the fault lines and racial disparities are for access to things like healthcare, credit, and housing. Recent research by the New York Fed revealed that Black-owned businesses are almost twice as likely to shutter during COVID-19 as white-owned firms. Black-owned businesses are also more likely to be located in coronavirus hotspots. I'm hearing about how these statistics are playing out for families through the regular conversations with community leaders, like many of you in our district and beyond. Far too many are facing unemployment, losing access to their health care, and dealing with the threat of eviction. Structural inequality stifles growth, but there is no single silver bullet that can solve the problems laid bare by the pandemic. As we look ahead to a full recovery from the downturn, we need to set a stronger foundation. We need more investment in health, in education, especially in the earliest years, in infrastructure, and in training the skills for well-paying jobs. There's so much work that needs to be done to make sure that we are fostering an equitable recovery and ensuring that everyone is able to fulfill their economic potential. That's why at the New York Fed and across the Federal Reserve System, a key area of focus is to better understand what contributes to economic inequities and to finding solutions. Our economic research and analysis, which my colleagues will share shortly, highlights many of these stark disparities. In addition, hosting conversations like this one creates dialogue around these issues and builds connections between those working for change. Another important role for the Federal Reserve, plays in promoting economic equity and access is supervising banks with respect to the Community Reinvestment Act. This law requires banks to lend, invest, and offer services to low and moderate income communities in areas where the banks operate. To emphasize all of our work in the space, the New York Fed recently published a statement reinforcing our commitment to fostering a more equitable economy and society. The pandemic painfully demonstrates the need for us to redouble our efforts in working with stakeholders from the community, businesses, nonprofits, and government to build a stronger, more equitable foundation for our economy's future. And this makes conversation like the ones we're having today so important for us to listen to and to learn from. Our shared commitment to an equitable recovery is needed now more than ever.
Thank you so much, John, for that statement. We really appreciate you taking time to spend it with us today. At this time, we're going to hear New York Fed research updates on economic inequality. I'm going to pass the mic to my colleague Nora Fitzpatrick, Assistant Vice President and Chief of Staff of the Communications and Outreach Group, who will moderate this panel. Nora, the floor is yours.
Thank you, Marissa. As been noted, the New York Fed researchers have been looking at inequality and the impacts of COVID across demographic and socioeconomic boundaries. Today, I'm going to have join us two of our economists who have been working on these topics. We welcome Laura Philosophe and Andrew Howitt. Laura is an economist in the macroeconomic and monetary studies function. She's going to share some of her recent work on which workers bore the burden of social distancing policies. Then we're going to have Andrew Howitt, Senior Vice President and also policy leader for the New York Fed's Household and Regional Research. He's going to bring us through how COVID-19 has affected the finances of different kinds of households. First, they're going to do their presentations, and then after the presentations, we're going to bring them together for a discussion. So first, over to Laura. Laura, welcome. Laura? Laura, if you're, Andy, do you want to start? Oh, there we go. Laura, are you there? Maybe she's having issue getting on. Andy, do you want to go first?
Sure.
See if maybe Laura
let's see if we
join
can
us.
do that. Yeah, that'd be fine.
Great.
Kelly, could you page forward to my part of the presentation, please?
There we go. Laura, I just saw her join.
Sorry about the delay here, folks. What do you think, Nora? Shall I go first, and then we'll see if Laura can get her connection?
Laura, are you there? Can we hear you? Yeah, Andy, I think we should go for you.
Okay. Kelly, could you page forward? I'll tell you when you can stop. If you... That's it. Great. Thanks, Kelly. And thanks, Nora. Hi, everyone. I'm very happy to be with you today to talk about these important issues. I'll be talking about how the pandemic, and especially the policy response to the pandemic, has affected household finances. And what I'll describe is based on work with many of my colleagues here in the bank's research group. Any mistakes I make are my own, and nothing I say should be taken as positions of the New York Fed or the Federal Reserve System. So let's get started. Kelly, could you go to the next slide, please? So the onset of the COVID pandemic, as John pointed out, put immediate and intense pressure on household finances. And that was primarily because of the labor market developments that we'll hear about from Laura when she has a chance to talk to us. One thing that policymakers were rightly concerned about was how households would be able to make their debt payments when income was falling because of these labor market dislocations. Now, that was a huge problem during the Great Recession when mortgage borrowers stopped paying in large numbers, and that contributed, of course, to a major financial crisis. Bankruptcies and foreclosures soared, and the damage from that experience is still with us, especially in minority communities, as we'll speak about later on. So an important element of the policy response to COVID was an attempt to avoid those bad outcomes. Now, there are a lot of potential ways to do that. Income supports like the stimulus payments and enhanced unemployment benefits that Congress passed are one kind of an approach. but so is offering payment holidays to borrowers. And I'm going to focus on that and call that kind of response, the payment holiday, a forbearance program. So these are loan forbearance programs. Now, one thing I want to mention here, and we'll come back to, is that by maintaining borrowers' access to credit, forbearance programs could even allow households to use their credit accounts to help maintain their consumption when their incomes fall. So in addition to income support, direct income support, keeping access to credit open is an important way to allow households to make it through the difficult economic time. So Kelly, let's go to the next slide and we'll see what policies actually got adopted. Well, there are two kinds of debt that households owe that have a large direct federal government presence. Let me switch the order they're listed here and start with mortgage debt. So there's roughly $10 trillion in mortgage debt outstanding. And according to the Urban Institute, over 60% of that is federally backed. Most of that debt is securitized by either Fannie Mae or Freddie Mac. Those are the GSEs, the government-sponsored enterprises. But the FHA, the Federal Housing Administration, which specializes in low down payment loans for moderately priced homes, is also a major player at 18% of the outstanding debt. Student debt is the other large area, the other large kind of household obligation that has a very substantial federal presence. Here, the federal government is actually the lender in about 90% of the loans outstanding. And there is a lot of student debt outstanding. As many of you know, that totals over $1.5 trillion now, the second largest form of debt on the household balance sheet. It's important to note that other kinds of obligations, auto and credit card debt, don't have a big federal role and aren't part of the CARES Act. But we'll see as we go through the data that lenders and servicers in this space could choose to grant forbearance, and they did in many cases. That's the same is true for mortgages held outside of these government guaranteed securities. So there's many opportunities here for forbearance to help the finance of households during the COVID pandemic. So let's go to the next slide and we'll see how well targeted these programs are. Let's start by talking about who doesn't have a student loan or a mortgage and thus won't be helped by the CARES Act relief. It turns out that's a lot of people. 63% of people with a credit record have neither a mortgage nor a student loan. These people tend to be older, which is usually associated with a better financial situation, but not in this case. This is a select group of older borrowers who have lower credit scores and higher credit card delinquency rates. They're also more likely to live in a majority Black or a majority Hispanic neighborhood. Now, we use our consumer credit panel data set for this analysis, which is drawn from Equifax credit reports, anonymized credit reports. And credit reports have no race info. So we have to use the information about the neighborhoods to make inferences and talk about neighborhoods where people live as opposed to the individuals in the data set. So fact number one is that a relatively large number of disadvantaged borrowers don't get any help directly from the CARES Act. So who does get help? Well, student loan borrowers, and there are lots of them, around 45 million. And student loans are held by almost all kinds of people. In fact, student debt is more common in majority Black neighborhoods than in majority white or majority Hispanic neighborhoods. Also mortgage debt, lots of debt, as I mentioned before, $10 trillion. And in broad terms, a very large number of borrowers, similar to the number of student loan borrowers. But mortgage debt is much more concentrated relative compared to student debt among advantaged groups. So for example, mortgage debt is twice as common in majority white as majority Black neighborhoods. So Kelly, let's go to the next slide and we can talk about how people got these forbearances and who got them. So how to get a forbearance, that differs by product. For student debt, all federal borrowers, and as I mentioned before, that's about 90% of the debt, was automatically put into forbearance. Now, some of you may be aware that student loan forbearances are very common even in normal times. The combination of deferment and grace periods, as well as income-based repayment plans, means that roughly 50% or half of student borrowers are in something that looks like forbearance even before the pandemic. But for other kinds of loans, a request to the servicer will typically be required. But in many cases, these were granted, as we'll see. So for auto mortgage, you had to ask your servicer to give you the forbearance, but typically, in many cases at least, these were granted. Now, I want to point out here that it's very important to recognize that borrowers can ask for forbearances and yet continue to keep paying. They may take out the forbearance, they may ask for the forbearance as a kind of insurance policy in case they're unable to make their payments. So what we'll be able to talk about is who's asked for, who's gotten a forbearance, not necessarily who has taken up that option. So let's look at some numbers on the next slide, Kelly. Okay, so here's the forbearance rate as of August on student loans. The red line shows the bars, the red line shows the average rate, and the bars show the rates for residents of different kinds of neighborhoods. Here we have majority white, majority black, majority Hispanic, and mixed, meaning no racial or ethnic group has a majority, measured at the zip code level. So the first thing to notice here is that there are very high rates of forbearance overall, around 90% for the average, that's the red line. And the blue bars are pretty similar across neighborhood types. So in other words, high rates of forbearance for student loans, and almost all neighborhoods are getting these high rates of forbearance. Now let's have a look at auto loan forbearances on the next slide. Okay, so first thing to notice right off the bat is these are much, much lower rates. Now the average, instead of around 90%, is around 6.5%. So about 6.5% of student loans are in forbearance. Recall that these forbearances are requested by the borrowers. And so we can reasonably infer that there's some distress or some expectation of potential distress by the borrower since they asked for this forbearance. But we can't rule out that they're just trying to preserve cash flow in any way they can. Now, if we note that the rate of auto loan forbearance in majority black neighborhoods now is 2.5 times as high as in white neighborhoods. In majority Hispanic neighborhoods, requests for forbearance or forbearances on auto loans are twice as high as in white neighborhoods. So there's quite a bit of variation now across different kinds of neighborhoods in the rate at which forbearances are being granted on auto loans. Now let's look at mortgages on the next slide. Here we see that the overall average is around 5.5%, and the same pattern emerges. Forbearance rates are much higher among mortgage borrowers living in majority black and majority Hispanic zip codes. So the last point is about how much relief these programs offer, and that also depends on the neighborhood. So let's go to the next slide, please. So the amount borrowed and interest rates vary over different kinds of borrowers, and so the amount of cash flow relief that these programs actually offer when they are put in place will also vary. So let's go to the next slide. And here we see that the reduction in monthly expenses that we're focused here on mortgage is very substantial for all the people who got forbearances. In fact, the average is about $1,700. So that's a month. That's a very substantial amount of relief that these borrowers are able to achieve. There is quite a substantial range, however, from about $1,400 for residents in majority black zip codes to about $1,800 in mixed zip codes. So let's go to the final slide. Here's the conclusion. The CARES Act debt forbearance has benefited lots of households, but many households, especially many less advantaged households, have neither student debt nor mortgage debt. So they didn't get direct support from CARES Act itself in terms of debt forbearance. The availability of forbearance options differs sharply across products and groups of borrowers. So for student borrowers, 90-some%, or about 90%, are getting forbearance automatically, whereas for mortgage borrowers, the numbers are well below 10% in most cases on average. Requests for mortgage and auto forbearance are highest in majority black and majority Hispanic areas, and we take this as likely evidence of higher levels of distress in these kinds of neighborhoods. And finally, the improvement in cash flow is substantial, particularly with respect to mortgage debt, but it is smallest for borrowers residing in majority black areas. So thank you for your attention, and with that, I will hand it back to Nora in hopes that Laura can join us.
Hi, yes, we have been able to get Laura. Laura, welcome. Over to you now, Laura. Then we'll bring you both back together.
Yes, thank you so much, Nora, and I apologize for the technical difficulties earlier.
No
I'm
worries.
delighted to be here today to be able to discuss some of my recent work on how the pandemic has affected workers in our economy, and in particular, how it's affected workers of color. So the starting point of our analysis, if you go to the next slide, was two simple observations. One, that social distancing policies or orders to stay at home might have different effects on different types of jobs, to the extent that some jobs can be performed from home and others cannot. The second observation is that the relaxation of these policies might happen in phases. So we've seen that happening in New York City, certainly, that places that are dense or require a lot of physical proximity are still not even open. For example, the bars are still closed. So to the extent that some jobs have a higher degree of physical proximity as part of the job's performance, those jobs are going to be relatively more affected by this pandemic. And just taking that argument one step further, if different groups of workers systematically work in occupations that are going to differ along these two dimensions, so their ability to work from home and their degree of physical proximity required by the job, then we might expect to see different employment effects of the pandemic by these different groups. So on the next slide, I just want to briefly describe how we set about measuring these types of characteristics for different occupations. So we turn to data from the Occupational Information Network, which is called ONET. It's basically a survey where they ask currently employed workers several questions about their occupation. And they have different questions that we thought were very useful in terms of relating to whether the job could be done from home and how much physical proximity the job did involve. So some examples of the questions that were asked were, how often does this job require working outdoors, exposed to all weather conditions? And that would tell us something about the degree to which the job could be done from home. And another question that was asked there is, to what extent does this job require the worker to perform job tasks in close physical proximity to other people? And then the answers were literally like at arm's length, or you're not close at all to other people. So moving to the next slide, I'll show you the outcome of using those measures. We use those questions to translate them into a measure for each occupation on a 0-1 scale, which measures both their degree of physical proximity in the occupation as well as the degree to which the job can be done from home. And that's what I'm showing you here in these two figures. The figures are plotting essentially the same thing. It's just dividing it by different sets of occupations. So if you focus on the left, it's looking at professional, management, technology, and services. And each dot represents a different occupation within that category of jobs. And if you look at the x-axis, going from left to right, you'll see the measure of physical proximity that we constructed using the questions I just described earlier. And on the y-axis, you'll see the measure of the ability for the job to be done from home. So two things came out of this analysis. The first is that we noticed that if you just look at the correlation across different occupations between these two job attributes, jobs that are less likely to be able to be done from home are also likely to be high physical proximity jobs. So as an example, just to give some color to the statistic, if you look at the top right dot on the left panel, that's healthcare and support workers. That's a type of job that has high physical proximity. So you have people who are working in very, very closely to one another when they are at work. And it's very rare that those types of occupations are going to be able to be done from home. On the other hand, if you look at legal jobs, which is the bottom left occupation in blue, legal jobs have very low physical proximity. Most of the time, those who are working in legal are sitting in front of their computer, and obviously that means that their job is one that might be able to be done predominantly from home. So going to the next slide, what we wanted to figure out next is how we could link these job or occupation characteristics to the workers that work in those types of jobs. So in order to do that, we went into the current population survey, which is the main survey used for the employment statistics in the US. And we asked the following question. If I look at jobs that, for example, score very high on our low work from home scale, what types of workers do those jobs employ? So in the top left panel, we're looking at low work from home jobs, and each attribute on the y-axis
looks at a binary attribute of a worker. So for example, the first dot at the top says that if you look at jobs that have a low ability to be done from home, they employ 40 percentage point more workers that do not have a college degree. So you can kind of go through all these attributes. I want to highlight, if you look at, for example, the non-white characteristic, what that tells you is that low work from home jobs employ 5 percentage point more non-white workers than do jobs that can be done from home. Now, if you turn your attention to the right panel, we do the same kind of analysis for jobs that have relatively high physical proximity versus low physical proximity. And you essentially, the same story comes out, which is that the most vulnerable workers, what we would consider most vulnerable workers, end up being the ones who are more likely to be employed in low work from home jobs as well as high physical proximity jobs. So to the extent that these types of workers are more likely to be employed in occupations that maybe were more exposed to the effects of the pandemic, one might think that this would show up in their employment outcomes as the pandemic progressed. And indeed, if you go to the next slide, you'll see that indeed was the case. So what I'm showing you here is February through April of 2020 employment losses for the same exact demographic groups that we analyzed in the previous slide. So the green dot tells you what is the excess employment loss that someone, for example, born outside of the US suffered from February to April. And when I say excess, I simply mean, relative to what we might normally expect from the February to April period that we've historically seen. So focusing, let's say, on non-white respondents had 17% larger than usual employment losses over this period, while for white respondents, they only had a 13% increase or excess employment loss over this time period. So that suggests that excess employment losses were 4 percentage points larger for non-white respondents than they were for white respondents, which is kind of what you might expect given their rates of exposure in terms of their occupational distributions. And finally, one last thing I want to show you on the next slide is a figure from the more recent current population survey where the BLS fielded some additional questions relating to COVID specifically. So before I was showing you employment losses by different demographic groups, here what this question is asking is, conditional on being employed, what fraction of workers by these different demographic groups said that they worked at home for pay at any time in the last 4 weeks due to COVID? So essentially, this is giving you an idea of the fraction of workers in these subgroups in May in blue and in August more recently in orange that ended up teleworking in the last 4 weeks. And you can see very clearly that Black or African Americans or Hispanic or Latino respondents were much less likely, conditional on being able to keep their job, to be able to telework or work from home. And this raises a very important issue, which is that, of course, with the pandemic, even if people are able to escape the possibility of job loss, these subgroups are less likely to be able to kind of shield themselves from the possible transmission of the virus because they are unable to work from home. So just to conclude, what we learned is that jobs that cannot be done from home are also more likely to be high physical proximity jobs. Generally, more vulnerable economic groups are more likely to be employed in these occupations. And in particular, people of color are more likely to be employed in these occupations, which means they might, and they indeed did, suffer larger employment losses. And conditional on remaining employed might have higher exposure risk due to the physical proximity nature of the jobs that they're in. And of course, this is just speaking about the recent pandemic, but it exacerbates already existing inequalities in the labor market prior to COVID. So turn it back to Nora so we can have some discussion about these.
Great. Thank you so much. Andy, I'll ask you to join us now. Hopefully Andy can join us. There you go. Thank you, Andy. Thank you both for your insights and presentations. We have just a few minutes for some, I'd like to have a discussion between you. Andy, you looked at households, you walked us through households, and Laura, you walked us through some of the impacts on the labor market. What about the connections between your work? Laura, how do you see your findings in relation to Andy's? And Andy, how do you see yours in relation to Laura?
Yes, so I think that, one thing that that we did find is that communities of color are more likely to be exposed to the effects of the pandemic. They're going to be more likely to suffer employment losses. And I think that could possibly be one of the reasons that you might be seeing higher forbearance take-ups, as Andy mentioned earlier. If they're losing one source of income, then they might actually require more of that assistance.
Yeah, that sounds right. That's probably the case both in the past, where we've seen sort of people taking up forbearance over the period that Laura's studying in the sort of the early part of the pandemic, but also in expectation that there may be further losses to come or further income declines. I think uncertainty, as John mentioned in his remarks, is very high now, and so people may be looking to get the option to improve their cash flow, and that would again potentially be correlated with race in the ways that we saw in the data.
Great, thank you. Okay, Andy, let's go back to households. I mean, you talked to us about household debt, but what does the other side of the balance sheet look like? And also, in discussing that, if you could, touch on how you and your colleagues' research findings may be relevant to building equitable growth in communities.
I think that's a really important question. And one thing that I'll mention here is something that I touched on during the presentation, and that's the lingering effects of the housing crisis of 2007 to 9 or 11. So for most households, the major asset, if they have any assets at all, is housing. But for Black households, they specifically have long had much lower rates of homeownership, so much lower rates of having access to that particular asset of housing. And that, in fact, got a lot worse after the housing crisis of the mid-2000s. So that was, why did that happen, especially to African-American households? Well, that was a result of higher rates of foreclosure for Black households during the crisis, and then a persistently lower rate of recovery, lower rates of entry into homeownership in the years following the crisis. So when we come to think about the asset side of the balance sheet for households, Black households have much less wealth to borrow against and to rely on as a cushion in times of crisis like we're facing now. So, I mean, what that implies for building equitable growth is that one of the main ways that households have built their wealth over time in the U.S. is by owning housing. And so to build wealth in many different kinds of communities, there are lots of factors that play into that, but housing is certainly one part of that story. And, one thing that's good to see this time around is that the policy interventions that have taken place so far have forestalled some of the worst outcomes that we experienced in the Great Recession. So hopefully we can continue to avoid high rates of bankruptcies and foreclosures because those tend to have really severe effects on the wealth of disadvantaged households in particular.
Thank you. Laura, in some of your other work, you've looked at how job losses have been found to have long-term effects on one's career, depressing earnings for many years. What can we expect for the recent COVID job losses? And what about the impacts and the experiences in communities of color?
Yeah, so there's a large body of work that has studied the effects of job loss, and you're right that it's extremely persistent. You see earnings differentials between people who lose their job and people who don't that last for something like 15 to 20 years. And one of the takeaways from that literature is that not only is it the earnings losses large and persistent, but they also are even larger if they happen during periods of recessions. So to that extent, that makes me a bit worried about job loss during the time of COVID, because it's obviously happening at a time of a huge labor market economic shock. And to the extent that people of color have more difficult times finding jobs, finding work, so their unemployment rates are historically higher than their white counterparts, you might expect that the consequences of job loss would be even more severe. So in that sense, the outlook is bleak. But what is promising about what's happening now is that there have been so many government interventions in the wake of COVID that I hope continue. And I hope that some of the discussion that we'll have going forward today is some of the policies that will be put in place to mitigate some of these losses that might be experienced.
Great. Well, we're just about out of time, but I was actually going to close with both of you on the question that you just remarked on. We're about to roll over to hear from our policy experts and practitioners. And, one of the ways that's played a role is some of the fiscal transfers have played a role in supporting households and workers during this challenging time. Laura, you just talked to that. Andy, do you have any closing insights on the impact of fiscal transfers that you've seen in your work?
Yeah, one thing that I would point out here is that, in my presentation, I showed that there's a very large number of people who have neither student debt nor mortgage debt. And, if you think about a renter who doesn't have a student loan or an auto loan, that's a large number of people. And for those households, the fiscal transfers that we had in the early part of the pandemic, the stimulus payments, enhanced unemployment insurance, were probably pretty darn important to allowing them to make their rent payments, et cetera. And there's some evidence for that. So I think it's important that we recognize that and acknowledge that forbearance programs can be helpful, but they are not able to reach all the households that might be vulnerable to the kinds of crises that we're experiencing now. And so it's important to have a whole portfolio of approaches, I think.
Okay, so well, thank you both for your time today. And, also thank you for your contributions to the inequality literature. We're now over to the next panel where we'll hear from a number of leading voices on this topic. Over to you, Marissa.
Thank you, Nora, Andy, and Laura, and thank you for your partnership on this economic inequality initiative. I should note that these presentations will be posted to the New York Fed's Economic Inequality Hub on our public website, so be sure to check them out. So as Nora mentioned, at this point in the agenda, we're going to hear from policy influencers on the racial wealth gap and workforce equity. We're also going to discuss an equitable economic recovery with a racial equity lens and specific policy recommendations. One slight adjustment to the agenda, we're going to start with Alejandra Castillo to accommodate Mersa Baradaran, who had a speaking engagement before this. I wanted to give her a few minutes to get her bearing. So without further ado, I'd like to introduce our good friend of the New York Fed, Alejandra Castillo, who is CEO of WYCA USA. Welcome, Alejandra. Thank you so much for joining us today from Florida. We're happy you could make it.
Thank you, Marissa. I'm in Florida now, but I'm usually based out of Washington, D.C., where I've lived for 30 years. So this conversation is not just near and dear to my heart, but it's also the areas that I've navigated for the entirety of my professional life.
Thank you, Alejandra. So first, maybe if you can start with telling us a little bit about WYCA and the organization's focus on racial justice and women of color.
Sure. So we are, just a correction, we are YWCA, not to be confused with another organization that sounds similar. And we are the largest and oldest women's organization in the nation, and the first fully racially integrated women's organization in the nation. So many people sometimes can get us confused, but we're very, very different. We do have pools, but we like to say that YWCAs have pools, but we really help women when they feel like they're drowning. So while many of our associations may have facilities for wellness, our true core is social services. So everything from childcare, we created the first childcare in the United States back in 1864. And childcare, after-school program, workforce development, women entrepreneurship, and we are the largest providers of services for survivors of domestic violence, among many other things. So again, not all YWCAs have pools, but we help women when they feel like they're drowning. And that is a statement that I make because right now, women across America are feeling like they're drowning. The New York Times in March 9th of 2020, called this the she session. The recession where women are at the core. So I'd like to talk more about it as we move forward with this conversation, but it's important to understand that YWCAs are in communities large and small, urban, suburban, and rural. We have 204 associations across the country serving over 2.3 million women. We have a slide deck that we're going to share after this conversation for anyone who wants to go a little deeper on what we do and who we are and where we are. But we have the finger on the pulse, and that's another thing that we'll talk about as we move through this discussion today.
Thank you, Alejandra, for that overview. So in our initial prep sessions, you referred to WYCA as the emergency room for the social sector. So can you tell us more about this? What are you seeing and hearing? And how have these issues evolved during the course of the pandemic?
Sure. So because YWCA is located in communities, as I mentioned, large and small, as soon as the pandemic hit, we mobilized and we surveyed our associations. We have become a very data-driven organization because we want to make sure that not only do we know who we're serving, but what is our social impact and how do we really move the needle by getting data as our primary source of information and decision making. And during the pandemic, we started surveying our associations, 204 of them, to get real-time data. And what we saw was, unfortunately, things that take a little longer to pop up into your data sets or even in the news. And what we started to see was the following: huge increase in domestic violence across the country. And then the complication of social distancing. Also, we had to pivot our childcare and turn them into childcare for first responders and healthcare workers. But we also saw the impact of social distancing on employment, on housing, with regards to education, the infrastructure, the social infrastructure in our nation, which up until now we thought was pretty strong. COVID really accelerated what the nonprofit sector knew for some time, that we had some really big strains into our social infrastructure fabric. For example, digital access. We talked about the digital divide, but right now we're talking about the digital abyss. It is shameful that students of color are going to proximate areas of a 7-Eleven or other stores just to get access to broadband. In rural areas where broadband is that last mile. So we really started to see the telltale signs almost immediately. And it's great that your colleagues share their data, but we can also share not just the data, but also that real-time information. So that's why I say that we are kind of like the emergency room from the social sector, because emergency room doctors start to see trends, and that's what we're seeing. We're seeing trends. And as Andy said, many communities of color were just about to start to move forward after the 2007 crisis, and now COVID hit. So they had to deal with the vestiges of the 2007 crisis, and now trying to figure out how do we get through that. So if I may just say one last thing is, we're about to release an amazing white paper that we've done in collaboration with the LBJ School of Public Policy with Dean Victoria DiFrancesco Soto. And we're excited because it's going to give individuals and practitioners, as well as economists, an understanding of how are we going to anchor this recovery around women. Just like women are at the center of the recession for a variety of reasons, they will also be the engine for the recovery.
Thank you, Alejandra. That was actually a great segue into my next question. We're very excited for this report, and we will be featuring it on the New York Fed's website when it is available
Yeah.
for public viewing. Can you please share some more key insights from the paper? Can you delve a little bit deeper into
Sure.
what to the paper specifically?
Sure. So we wanted to dive deep into what's causing, why are women at the core, and how will women be that engine, and what's the ecosystem that needs to take place. So just for purposes of clarity as well, we're dealing with multi-crises here. We're dealing with not only the pandemic, we're dealing with the economic crises, we're dealing with the social and racial justice inequality, the cry for racial justice. We're dealing with environmental. I mean, our colleagues in the West Coast are in dire situation, but also, we're still in hurricane season. We're dealing with a crisis of trust. Who do we trust? Where do we go for information? Who is there to have our back in a very colloquial way? And as well as a crisis of leadership. So when we talk about all of these crises together, we wanted to go deeper and to have a conversation of what will it take to really support women, especially women of color and communities of color, to move through this moment in time. And what's become very evident is, look, we need childcare. Women will not be able to go back to work unless there's affordable and quality childcare. It's a crisis that's been long in coming. It's not new. And again, I go back to this comment. We knew where these fault lines were before the nation did because we're on the ground. Now COVID has elevated that and has accelerated the need to really do some paradigm shifts and to reimagine what these social structures need to be in order to have an inclusive economy. The other thing that we understood is, issues of race and systemic racism. When you look at pay equity, women of color are at the bottom. I mean, there's the gap of pay equity. When we talk about environmental issues, communities of color are in situations or in areas where there is a constant situation on environmental justice, climate change, and the rest. But overall, here's the other thing, the future of work. Many of the jobs that were lost in retail, hospitality, restaurants, these are all jobs that may not come back. So how are we going to reimagine the future of work and skills building as we talk about women of color, and communities of color? Because we are the privileged few where we have an opportunity to work from home, to have these great conversations. But first-line workers, essential workers, how are we going to reimagine the way that the future of work is going to incorporate in communities of color, especially for women?
Thank you, Alejandra. And in the last 3 minutes, I wanted you to focus specifically on what role philanthropy and the private sector can play in supporting workforce equity. You've already spoken about an equitable economic recovery, but really, what can those two do to support workforce equity going forward?
Well, first of all, is to understand that the old system doesn't work. That this is the moment to think boldly, to have partners like us at the table so that it doesn't trickle down. We have the data, we have the understanding of how communities are either working or not working. I will also tell you that for philanthropy, we've had some incredible funders and supporters who have been very, very generous and understanding. But philanthropy has to do more, and so does government. I worked in government for a very good chunk of my life, and the policies that are currently in place are helpful if this was episodic, if this was just a blip in our trajectory. But this is not episodic. What we're going through and the multitude of crises that we're facing are really transforming who we are as a country and what is our responsibility. So I make a plea to philanthropy to join us, to make us partner in the design and the reimagination, and also the reality that our current systems never envisioned women and communities of color at the table. So we've inherited the rules of engagement. And YWCA's genesis was in the first industrial revolution, and that's why we had to create childcare and march for the 8-hour workday and fight for equal pay. As we embrace the fourth industrial revolution, we must be at the table. And if you don't see us at the table, I hope that we have allies who will call for women and communities of color, because to reimagine and to redesign a society that is much more inclusive and equitable requires us to be equal partners. So I thank you for this opportunity. You know, I've worked with the Federal Reserve Board in various positions throughout my life. A big shout out to Claire Kramer, who is fantastic. But at the end of the day, I value you as partners, as well as an institution that can move the needle. So thank you for this opportunity to be here.
Thank you, Alejandra. You've really underscored your role as a data collector, as a leader, and a practitioner in this space, and we look forward to receiving the report. Thank you for all of your insights. We really appreciate you taking the time today.
Absolutely.
Our next presenter, who has joined us from the West Coast, we're so happy that she was able to make time for us today, is Mirza Baradaran, Associate Dean for Equity, Diversity, and Inclusion at the University of California, Irvine School of Law. Mirza is also the author of The Color of Money, Black Banks, and the Racial Wealth Gap. Thank you so much for joining us today, Mirza.
Thank you so much for having me.
Oh, great. We can hear you. Perfect.
Okay.
So my first question for you is to tell us a little bit about how systemic racism and investment in communities has impacted Black banks in the U.S. and ultimately wealth building in communities of color.
Yeah, so I'm going to start with a Martin Luther King quote here. You know, and he says in I think 1967, measuring by the sort of metrics by which we measure sort of depressions and recessions and that stuff, the Black community has been in a perpetual state of depression, you know, since emancipation. And I think, you know, I really love the Fed's you know, recent conversation about focusing specifically on metrics like the racial wealth gap. But as Alejandra just noted, it's not new. These gaps are long lasting. And the thing that crises do, and this is true now and also of the subprime crisis and of the Great Depression, is that they actually just, create a shock across the sector, but it's really those communities that are most vulnerable who get hurt the most always. So there was this adage that came up as I was researching the book that, you know, when Wall Street gets a cold, Harlem gets pneumonia. And I think you can see this in health terms, right, with COVID, but you can also see it in the way that the virus and the response has really just disproportionately affected Black communities that were already hadn't fully recovered from the last financial crisis. And in the way that we measure market health. You know, I think those are some metrics that have really, hopefully we can highlight going forward, especially as the Fed's in the data collecting that the Fed does and that other institutions do, but in really showing that, you know, the stock market health and the, you know, even GDP factors and numbers don't actually tell a full story often, especially when it comes to certain communities. And so you can still see, you know, the evictions that are about to come, the jobless rates, those end up being concentrated on specific communities. And so, yes, like largely you can say, oh, eviction numbers are here and the employment numbers are here, and generally the stock markets, it is, you know, is rising, and the GDP, you know, and so we take these numbers as a whole, but the way that their effects work out is actually it's the same people who are being evicted, who are losing their jobs, who are not invested in the stock market, who aren't getting these Fed bailouts. And it turns out that these are the same communities and people and women, as Alejandra points out, that have been on the margins because of these historic trends. And so it's really important to even as a first matter, just to start to measure, to be more finely tuned in the way that we collect data and report it. In that, yes, you know, maybe we can say like the white stock market is doing great, right? And that's a crude way of putting it. But if you look at the data, really, who has money in the stock market? How many of us, you know, does that matter to, versus those who just need wages and shelter, and who struggle to find adequacy in those things. As far as Black banks, your question, I mean, the 2008 crisis, as former Congressman Brad Miller talks about, was an extinction level event for Black home ownership, and it was also that for Black banks. So there was about 50 or more before the financial crisis. There are only 20 now. There is this new Black bank drive that has been happening, but the banks need more than deposits. They need capital, and capital is exactly the type of thing that is short in communities because of the histories of segregation. It really does come back to housing being the major asset for most middle class people, and the way that these markets of segregation have worked is not only that there are way less home ownerships, due to lack of down payment, lack of that history of home ownership, in the FHA programs, and also just lack of wealth and business access and capital for the banks.
Thank you for that context. I'm hoping that you can talk specifically, and this is something that you focus on a lot, on strategies to increase resources to chronically underbanked communities and build financial stability. You have some strategies related to postal banking and to combat predatory lending. Can you talk about those?
Yeah, so when you look at the numbers of the unbanked and underbanked, they have disproportionate racial sort of effects. So unbanked and underbanked, among white communities, it's usually the same. It correlates to lower middle income. So lower middle income folks, and especially those who live in urban areas that had been redlined historically, or now increasingly rural areas where banks, because of increasing mergers and other trends in the industry, banks are no longer available in those areas. And so, you have a problem with unbanked and underbanked, and this hits, Black and brown communities more because of lots of legacy reasons. And what ends up happening is that, to fill the needs of, increasingly digital world, is that you have to end up relying on alternative fringe lenders, payday, check cashing, and you can, really map out where the banks have left and who has filled the void, and especially since the late 80s or the early 80s where interest rates were deregulated, you have a really no cap in the ways that how much interest can be levied by pawn and title and payday, and that's a really difficult sector. And so I anticipate that as the CARES Act responses stop, and as people start really going into their 6th month of unemployment, that you would start seeing a resort to those institutions without actual help, and so that would really highlight and put more pressure on these communities. Postal banking is something that I've proposed as of 2013, and it's something that keeps coming up. Unfortunately, as more crises happen, I think more people understand that this is a problem, even though it's been a long-lasting problem. The idea that when the $1,200 of the CARES Act was passed, and just getting that money to people was a problem. So you had in New York City even hours and hours of people waiting in line at the one ATM, one bank, it's called Key Bank in New York, that didn't have a fee associated with it. So you can take out the $1,200 without a fee. And so people came in from Queens, from the Bronx, just to line up at this ATM, and it was mostly Black and brown people, a lot of women who were wanted to save the $3 to $5, and that's a big deal. That can mean that's a meaningful sum of money, and if you add that all up and all the fees that they have to pay because of the lack of a transactional account or payment system. And so the idea with postal banking is just to offer a simple transaction account, so checking account, debit card, which is what the majority of consumers that make under $50,000, their primary sort of access point is a debit card. And so to meet people where they're at and to offer that debit card without the overdraft fees and the random and punitive and accumulating fees and sort of charges that pile up, and do it through the payment system that is offered only through banks, and to kind of open up that route for them. So that's the idea with postal banking, and it would really help, I think, all communities, not just Black and brown communities.
Thank you for that. That certainly is a groundbreaking idea. So within the context of an equitable recovery from COVID-19 and a racial equity lens on an equitable recovery, what role can the New York Fed and other regulators play in advancing economic mobility for communities of color and working to close the racial wealth gap?
I think the tools that the Fed has are probably the strongest right now. I mean, obviously, it's better for. I mean, I know there's a debate between monetary policy versus fiscal policy. It's better that these things are done in Congress, but they're not. And a lot of the monetary policy is actually does have distributional effects. And so, just really thinking about which markets to use the monetary policy ammunition in, right? Do we back up the commercial paper, corporate bonds, or focusing on municipal bonds and communities, and how the Fed can use just their market making and market participating functions. And I know it's much easier. I mean, I'm a New Yorker, and I worked on Wall Street. I was at Davis Polk for a couple of years, and I know that there is a way that things are done, and the New York Fed specifically works with a certain community of bankers, and that's just a legacy sort of thing. But just kind of reaching out into what other community markets could we use the same monetary policy tools without changing anything up, but like directing those aids to those other markets that are also in unusual and exigent circumstances. So moving away, I think, from just focusing on the health of the banks. I do think that the health of the banks is important. I don't think that it's not, but to make sure that the banks are helping, or that money is passing through in a way that it should be. And if it's not, then going directly to communities. I think that would be really, really useful.
Great. And I wanted to also ask you what role you think philanthropy and the private sector can play. And we also have grassroots organizations and community organizations on this call. So what role can those stakeholders play in working towards an equitable economic recovery from COVID-19?
I mean, a lot. I think I hope that some of these responses are policy based, and so just really being active in pushing for the right things policy wise is a huge role for philanthropists and grassroots organizations to play. It's really organizing and getting a lot of this stuff has very disparate and broad benefits, right? Any programs that are for lower middle income people aren't going to have like a direct lobby to push on Congress and on the executive, and so that's a place where grassroots organizations and philanthropists can really say, like, what are some issues that can actually help people, and how can we push that to the right people, creating the policy, and because there isn't a natural, financially incentivized lobby for those things. And there are plenty of counters. So payday lending, right? How do you counter that when you have, the broad coalitions of people who need the payday loans versus a few payday lenders who actually are way more powerful? And so how, in those scenarios, philanthropists and grassroots organizations can really help shift that political dynamic.
Thank you, Marissa. I wanted to ask you if you have any more thoughts on the topic of equitable recovery and the crisis in general before we close. It's really an honor to have you on here. So do you have any final thoughts before we close and move on to the next panelist?
Yeah, I mean, yes, I think, the Fed and federal policy is where a lot of this stuff initiated. It's a history, a legacy of not just the Fed, it's every organization in the country is sort of implicated historically in creating some of these problems. And that is not to say anything besides we have a racist history, right? We have a history of racial exclusion, and everyone was in it, and every institution perpetuated it. And when I talk to organizations, it's, instead of thinking about like, oh, well, if those things outside change, then we could follow along, or if Congress were to mandate us, then we could do it. But I think it really, every institution can look within its own history and its own backyard and say, what has the New York Fed done historically to create these problems? And how can the New York Fed, within our own orbit, fix this, or plug in an institution. What has Bank of America done historically to cause harm? And if you don't know, then there are people who research this. There are people that can help from the outside or the inside of the organization. And just what can we do, at least even to not perpetuate these harms, right? And not just reach for the easy symbolic solutions, which are usually cosmetic, which are putting different faces on the same programs, or making statements that aren't backed with some real changes. And so I think every organization should do some looking at their own policies and programs and history, and look for remedies there. And recovery, I think, pushing really on policymakers, not always just to benefit those who are always being benefited by recovery programs. I am not a huge skeptic of right now what's happening. I think the CARES Act was a really good start, and the PPP, I think those, just if we follow those along, those are really good programs.
Thank you so much for your insights today. I know a lot of our colleagues from the New York Fed and other regulators are on this, or in this event, so I'm sure that you've given us a lot to think about. I'd like to thank you so much for tuning in and joining us from the West Coast, and we appreciate your insights. And to all of you who have joined us today, please check out The Color of Money, Black Banks and the Racial Wealth Gap. Order it, read it. It's a great read, very insightful. And thank you again for joining us today.
Thank you so much for having me. I really appreciate it.
Take care, stay safe. Our next presenter is Sarah Truehalf, Vice President of Research at PolicyLink. Hi, Sarah.
Hi, thank you for having me.
Thank you, Sarah. So Sarah has a presentation, a formal slide deck here, but Sarah, before you get into the presentation, I'm hoping that you can talk briefly about PolicyLink and your recent work on racial equity, and also the report, Race, Risk, and Workforce Equity in the Coronavirus Economy, and the gap that you were trying to fill by conducting this analysis.
Yeah, absolutely. So PolicyLink, we are a national research and action institute. We're based in Oakland, California, but we work across the country. We truly believe that addressing structural inequities around race and inequality is critical to our economic future and the future of our democracy. And so that's what we focus on. And we have a research partnership with the University of Southern California's Equity Research Institute, which is where this research comes out of. And it's the National Equity Atlas Partnership. And we formed in 2011 to add deeply disaggregated data to the conversation, and to put out research that highlights the current state of equity or inequity in our nation, and going down to the local level for cities and regions and states, as well as the United States, and equip policymakers and advocates with that information so they can develop targeted solutions and strategies to advance equity. And a lot of what we look at is how our demographics are shifting, right? Already, the majority of new entrants into the workforce are people of color, yet we have these persistent inequities from discrimination and embedded into policies and the history, like Mirza mentioned. And so how do we address that issue for our economic future? So that's really what we're working on. And we've put forth a lot of material around what to do in this crisis. And this report, actually, we were not planning to write this report at all. We were in the middle of a multi-year workforce equity project in working with 10 coalitions and communities, cities across the country, on how do they bring a racial equity lens into their workforce strategies and choose investments and policy strategies. And then they were working in a tight labor market situation. How do you get people into career ladder positions? How do you improve the quality of jobs? And then COVID hit. and everything changed dramatically. So luckily, we had a partnership with Burning Glass Technologies, which they have a pulse on the labor market because they look at job postings on a regular basis. So we were able to partner with them to produce this analysis looking at what is happening at a time when we really didn't understand what the equity impacts were back in June when we released this.
Thank you, Sarah. I'll let you get into your findings and policy recommendations in this slide deck, which has been loaded and ready to go.
Excellent, thank you. And you can kind of go forward a couple slides. This is just the introduction to the National Equity Atlas, which I shared with you already. And here is the report, Race, Risk, and Workforce Equity in the Coronavirus Economy. And in the next slide, you'll see the places where we were working that I just mentioned and the partners. So there were multiple partners to this, including the National Fund for Workforce Solutions, as well as Burning Glass. And the cities included Seattle, Boston, San Francisco, 10 cities across the country, Nashville, Miami. So getting into our findings, and again, this is for the period of time looking at the job postings data and what was happening there between March 2nd and mid-April. So the first thing we found was, of course, this dramatic collapse in demand across the economy. So what you're seeing in this image, this chart, is the change in weekly job postings. And so on your left, those are the declines, and then they're colored by the essential jobs and the non-essential jobs. So of course, you're going to see this dramatic decline in postings around non-essential jobs. And some essential jobs we actually did see an increase in, but very few. And then the vertical axis is looking at the level of risk, which was touched on by Laura in the previous presentation. So just this collapse in demand across these positions, especially for non-essential workers, a new category. Next slide. And what we saw was when we disaggregated by the earnings level of the occupations, what you see is actually that the worst declines were among the lowest paid non-essential workers, right to the far left of this chart. The workers that are earning less than 10,000, very low wage workers and occupations, that's where we saw the most decline, and a lot of occupations where workers of color are concentrated, like sub-minimum wage and tipped workers. The next finding relates to race in those occupations. So we were able to cross the data on job postings with the demographics of the workers in those positions. And what you see here in the orange represents occupations where people of color are concentrated in them, and the gray are ones that are white workers are concentrated in them. And what you see here is, of course, that people of color, workers of color, are concentrated most in the positions where there were the most declines, the hardest hit by this downturn. And that white workers were more concentrated in the jobs that weren't as hard hit, although we did see declines throughout the labor market during this period of time. But workers of color were overrepresented in 11 of the 15 hardest hit occupations. So there were definitely these significant racial impacts of the downturn. We also, looking at the risk levels in jobs that are the non-essential occupations, we looked at the COVID risk levels to think about how long people will be impacted by this downturn, right? Because we had the shutdown orders, it was a known shock, but when will people come back? Well, we see that workers of color are most over-concentrated in the highest risk occupations, which are going to take longer to come back, given the pandemic and the health risks. So you see Latinx workers have the highest rates of concentration in these jobs, but also Black workers, Native American, Pacific Islander workers. And then looking at the essential jobs here, shifting back to the essential jobs, we looked at job postings here, and we also saw declines, right, in the essential jobs. But the biggest declines were experienced by Native American occupations that are primarily filled by Native American workers and immigrant workers. So we also saw these impacts by nativity, and especially for Native American workers. And the next, and then this slide and finding speaks more to wages, which we've touched on a bit already during this webinar, that what we see across all of these categories, we separated out healthcare, which you see in the orange on the right, and then the non-essential jobs and the essential jobs. And we broke it out by race and gender. And what we see is this concentration of workers of color, and especially women of color, which is another gender, is another thing we've been talking about today, in the lowest wage positions across all these jobs, right? So this is something that's structural in our economy, but showed up so much as we saw this recession and saw our threadbare, safety net. So that was another finding from this analysis. And we were able to run the same analysis for the 10 regions where we were working for the Workforce Equity Project already. And we looked at across those regions, did we see any differences based on the composition of their economies in terms of the job losses across sectors or across occupational categories? And we did see some differences. So we saw that the regions that were driven most by tourism, like Miami and Nashville, they experienced these stronger economic shocks, and the regions whose economies are more driven by advanced industries and higher tech jobs, like San Francisco and Seattle and Boston, they had somewhat of a moderating effect, or it looked like it did across these 10 regions. So from this analysis, which really showed how across the different occupational categories, you see workers of color are really hardest hit by this recession, and overall in the lowest paid positions because of occupational segregation and structural inequities in our labor market. What do we need to do going forward? So what are the policy recommendations? We really believe that we need race-conscious solutions and strategies that are targeting those who are most vulnerable and hardest hit. But we need a floor for all workers. I think that this recession really exposed that we lack the strong social safety net that we need, and we did, implement some strategies that were really beneficial, have helped people out, but it just shows that overall, we need a stronger safety net and a stronger social compact. So we look at the three categories. So we look at essential workers and what we need to do there. Obviously, we need to have adequate safety protections, and we need to ensure the health and economic security of these workers. And so paid sick days, whether it's at the local level, national level, whether it's employers themselves, ensuring that people have access to that at all times. And of course, universal health care that's affordable to all. And then raising the floor on low wage jobs through the minimum wage and other job security measures. Next slide, please. Looking at workers who've experienced unemployment and job losses. How do we ensure economic security through systems like our unemployment insurance system, but also cash assistance, as we saw with the CARES Act, has been really critical in this moment. How do we ensure that people who've been displaced from their jobs can come back? That's really critical. And then looking at the career pathways and training opportunities, apprenticeships, and skills development to get people into more stable and secure jobs. And then the last category is looking at our economic future and how do we put in place policies now that prepare workers for the present and future of work. So I think it was really clear the need for digital skills when the pandemic hit. And even now we work with our partner in Phoenix who has their workforce entity there is saying that, you know, people are coming in and they don't have computers and broadband, you know, the hardware, but then the digital skills to even connect to jobs. So that just shows what we need to do to get people ready. We are strong advocates for a structural solution, which is a federal job guarantee, ensuring that everyone can have access to a good job. If we had had a good job guarantee in place at the beginning of the pandemic, we would have been able to transfer money to people who are at home and allow them to stay at home and then ship them into jobs in public health, in contact tracing and testing and supporting the recovery. So we need a set of race-conscious, targeted solutions and structural changes to put us on track for an equitable recovery and you know, a strong economy in the years to come. One of the analyses that we've done through the National Equity Atlas Partnership is how much stronger our economy would be if we had racial equity in income, right? And nationwide, it would be $2.7 trillion more in economic output per year if we didn't have racial inequities in income. In the New York region, it would be 33% higher GDP. So we can all benefit from implementing race-conscious, racial equity solutions. Thank you. And the last, here are some of the resources that we've been creating since the pandemic. Some strategies and policies and commentary. And then the last slide includes a link to the National Equity Atlas. It truly is a treasure trove of data. So I recommend that you go to the National Equity Atlas and check out what equity looks like in your community. Thank you.
Thank you so much, Sarah. And we will be sure to share these slides again on the New York Fed's website. But we really appreciate you underscoring the importance of having a racial equity lens as we look towards an equitable economic recovery. That's critical. So thank you to you and PolicyLink for all of the analysis. This is really critical information right now for many stakeholders. So we thank you. I want to thank all of our presenters. I want to thank our economists. I would like to thank our events team making this possible. And without further ado, I'm going to turn it over to Senior Vice President and Head of Outreach Education, David Erickson, who will close this event. David, the floor is yours.
Thank you, Marissa. Can you see me?
Yes, we can see and hear you.
Oh, great. Okay, good. Well, Marissa, thanks for convening such a superstar group of people to walk us through this very important issue. I just wanted to draw people's attention to the fact that this is the third in a series where we're trying to bring sort of, as some have remarked in years past, bringing Greece to Rome, you know, bringing the ideas and trying to understand more deeply what the issues are and then think about what are the actions we can take in order to address those problems. And we've had in the past discussions around how COVID-19 is affecting immigrant communities, how it's affecting housing, how it's affecting minority-owned businesses, and later in the fall, we'll be having another event of this type. Again, focusing on the research, but also focusing on what can be done to sort of address the problem the research identifies. We'll be having another event focusing on education, children, and families. So very much appreciate your leadership, Marissa, and curating these conversations. I did want to sort of, I think to Marissa's point, you know, when you know, Wall Street catches a cold, Harlem gets pneumonia, you know, I think we are very much focused on that as an institution. Some of you may be familiar with the Main Street liquidity facility that has, we've been working very hard to try to bring the minimum loan amount down and then extend it to not just businesses, but nonprofits as well. We have a long way to go before we can start bridging into those communities that are really struggling. But as John mentioned earlier, he was quoting some research done by Claire Clamer Mills on our staff on the report Double Jeopardy, where the analysis showed that in areas where African-American owned businesses concentrated, those were also hotspots for COVID-19. And those areas were less likely, on average, to get, that they received less money from pandemic relief efforts like the Paycheck Protection Program. And so we are aware of these problems. We are doing our best to try to get at the root of them and to find partners that we can work with to sort of build bridges to those places. It's hard as the Federal Reserve is, as Jerome Powell has said in the past, we are a lender. We can lend, we can't spend. And so in many cases, those organizations, the very small businesses, the nonprofits on the front lines are in a situation where maybe having an additional loan is not what they need. They might need grants or some other financial tool to help them through this crisis. And so we need to partner with foundations and philanthropy. We need to partner with all levels of government, and not just the federal government, but state and local governments as well. So we are working hard to try to come up with some of those solutions. We are really dependent on you, the audience, to help us so we can capture as many good ideas as possible. I just hope you stay connected to us in this conversation so that when we get on the other side of this crisis, that we will have been able to put together some strategies that really can help close the racial wealth gap, close the opportunity gap that so plagues us as a country. I just draw your attention to this ongoing conversation that's happening on our website, that economic inequality website that Marissa has mentioned earlier. Just can't thank you enough for being engaged with us during this process. I did want to give a special shout out to Karen Bond and Kelly Jackson, who have been behind the scenes making all of this work. And I just think I really want to thank them for that. There's a lot of work that goes into something like this, and we can't thank them enough for making sure it went very smoothly. So thank you all for joining us, and we'll look forward to seeing you in a few weeks to talk about kids and the crisis.